Welcome to Fundera's webinar on how to improve your credit score. Thanks for joining us this summer. I hope it is nice and lovely where you guys are. So first, we're just going to start with a few brief introductions. My name is Kahmai. I'm a senior account executive here at Fundera, and I will also be joined today on this webinar with my associate, Colin, who's also a senior account executive.
Yeah, Kahmai and I are really excited to help everyone understand personal credit and how that can help you get into make better financial decisions for your business. We're both senior account executives here, which is essentially a fancy word for we help you find out the best financial product your business qualifies for and make sure it fits with their business needs. And personal credit score of business owners comes into play for a lot of these factors. So we're really excited to share this information with you.
Awesome. So I'll go over a brief agenda here. We're going to go over an overview of your personal credit. And we're going to talk about why your personal credit matters, the basics of building up your personal credit, and some few unexpected ways that you can actually help improve your personal credit. And just to note here, we are specifically talking about personal credit today throughout this webinar. We may have a webinar on business credit at a later date, but today we're just going to focus on personal credit as it's one of the most dominant factors in looking for business lending here for every single business owner in the country.
All right, so why does personal credit matter? You may be asking yourself why you've been on the phone looking for business financing and they ask you about personal credit and you're like, this is on my business. I don't know why personal credit matters. And to be honest, that's a great question. All small business lenders take into consideration the personal credit score of the small business owner. Essentially, that's because they want to make sure that the captain of the ship pays their bills on time. Especially with smaller businesses, the financials can be a little bit, they could blend together a little bit, especially whenever it's a one-man shop or something like that. So for lenders that they've decided or they've determined that the credit worthiness of the business owner highly influences the credit worthiness of the business itself.
Awesome. And as you can see here, there is an obvious correlation between what your personal credit score is and securing business financing. So as you can see here on the x-axis, we've got your credit score. If you're in the 630 range, chances are you're going to qualify for a shorter term loan, think anywhere from 3, 6, 12 months. You get a little bit better here into the 660 range. You're looking at securing potentially a line of credit. But then as we get here above 690, you can start to see you're looking at those medium-term loans. Here that means anything from 2 to 5 years on average. But once you hit 700 plus, that's when you start looking at qualifying for government-backed loans like the SBA loan, as well as other bank loans and bank lines of credit as well. And just to note here, the average credit score of Americans last year was right around 700. So if you're not there, don't worry. We're going to help you get there. But really, a lot of people think 700 is good, but it's really just kind of the middle of the ground. You want to be, 750 plus really in terms of having an excellent credit score.
Gotcha. So Kahmai just mentioned this earlier, 700 is a good credit score. We really want it to be a little bit closer, as far up the 700s as possible. We do understand that as a small business owner, it can be a little bit of a balance act to keep your personal credit score up there. But in the following slides, we're going to teach you how to better balance the strain that might be on your personal utilization for your credit score, and then also the debt that's going to be on the business.
Awesome. So obviously having an excellent credit score does help unlock some of your credit options here. So the more options that you have with a better score, the better loans you're going to secure and the more loans you can secure. So that's one of the big pieces of takeaway there is you really want to have a solid credit score to help you open up your lending options, which essentially helps you get a better credit score, which helps open up your lending options. It's a very cyclical cycle there.
Okay, so there's several different factors about how credit score is calculated. And if you get into the nitty gritty of it, it can be really confusing to understand with a lot of mathematical formulas involved. But essentially, it boils down to something that's very simple. I like to think of a credit score as being something like a stool with three legs. So the first leg of your credit score is the payment history. That means that you should be paying all of your bills on time, all the payments on your loans, credit cards, and other debt. That's going to determine about a third of your credit score. The second leg of the stool of your credit score is going to be determined by your personal utilization, and we're going to get into exactly what that utilization means in a few slides. But essentially, it means how much of the available credit you're actually using at any given time. Now, the third leg of the stool is going to be made up of a few things. The first is going to be the length of credit history. How long have you been an active borrower in the financial system? The second is going to be credit activity, as in how often are you applying for new financial products? And the last little bit is going to be the diversity of the credit. This means that if you have a mortgage and a car loan and a credit card and a business loan, that's going to be a higher diversity of credit than just a credit card or something like that. So you really want to think about this as 1/3 of it's going to be your payment history. The second is how much you use out of your available credit. And the third is going to be a blended amount of how long and how active you are in the financial markets.
Awesome. So I'm going to take over here. What is your credit utilization? We just touched on that. So your credit utilization does refer to the maximum credit across all of your credit lines that are connected to your social security number. So a prime example of this, you open up one credit card, it's got a $10,000 limit. You use that credit card and you buy something that's worth about $1,000. You've now utilized 10% of your available credit since you only have that one credit card. So that's what's going to equal your utilization percentage. But one key here to note is we look at example 2. If you have 5 credit cards, all with a 10K limit, your new available credit becomes $50,000. And why is this important? Because that same $1,000 purchase now takes up significantly less of your available credit, thus bringing your utilization down significantly. So here your utilization would only be 2%. So it's crucial to know what your utilization is and keep in mind your credit cards will go to this, but if you also secure personal loans, those will count towards your total available credit. So for example, if you take out a new loan, a personal loan for $5,000 to buy a new piece of equipment, that might impact your personal credit utilization because you've now used up that full $5,000 in terms of the loan. So it's key to remember that the higher the credit limit that you have, the higher available credit you have available to you, the lower your outstanding balance is going to count against your utilization, and vice versa. If you have very little credit available to you, it's gonna, even the smallest purchase, you buy that pack of gum, it's gonna cost you a little bit more there in terms of your utilization. So as we saw in the last slide, utilization makes up 30% of what builds your credit score. So, that's something that we have a lot of control over, right? Is how we're using our credit, specifically with credit cards. And so it's really something to keep in mind is what is my current utilization? What's my total available credit? And how can I keep that in an area that's going to benefit me when I look at any other financing options?
All right. So just as sort of a brief recap here, as far as the business climate during this whole coronavirus situation with COVID-19, we understand completely, and we talk to business owners every day that have had an incredibly tough time during the lockdowns. And we understand that government assistance hasn't met everyone's needs completely. And we want you to understand that it's not your fault that you're put into this position. However, it is still very important that you put your best foot forward as a business owner while navigating through these times. And that's what we're trying to help you do.
Awesome. So let's go over the sort of basics here. These are pretty simple to a lot of you, but it's always worth repeating. Number one, you got to pay off your existing debts. Number two, as we just mentioned, you've got to reduce your total credit card utilization and your total credit utilization in general. Tip number three, obviously avoid hard credit pulls, and we'll get into why that's important a little bit later. Number four, keep those credit cards open even if they do have a zero balance. We'll talk about why that's important down the road as well. And then number five, obviously, dispute any derogatory marks on your credit report. These are just the basics in terms of building a strong credit. And again, it's important to think, hey, what steps can I take? What do I have control over right now that I can use to improve my credit, rather than sitting back and saying, oh, my credit score is terrible, I don't know how to fix it. So we're going to give you some of those tools to say, okay, I can pull this lever and this other one is just going to take time. Or I can change this and I'm just going to have to wait for this other one. So knowing what those levers are is really important.
Okay, so the first bullet point here is pay off existing debt, but we want to be sure that we're paying off the right kind of debt first. We want to make sure that we're focusing on higher interest and also debt that's going to be affecting your personal credit utilization, because not every form of debt that you have is going to be showing up on your credit utilization. So what you need to focus on are typically, this is limited to just credit cards and also personal loans. Those are the ones that we find talking to business owners every day. That's what utilization is riding on. You don't necessarily need to focus on paying off your car loan or your mortgage or anything like that, because those are collateralized items. And then credit cards and personal loans are typically uncollateralized. So that's why they're driving up your utilization. So it's fine to keep paying off your mortgage or your car at a steady rate, but I would try to be as aggressive as possible when going after your credit cards and also your personal loans. And just as an aside here, please remember that often even business credit cards are showing up on your personal utilization as well.
Awesome. And number two, I guess you call me Mr. Utilization. Let's talk about how we actually lower that utilization, right? So there's two main ways I've kind of alluded to here so far. Number one is decrease your current balance. Hey, I've got $500 on and $1,000 of total available credit. If I pay that down to $250, my credit utilization is going to go down. So again, we can see here 0 to 9% is excellent. 10 to 29% is good. You really want to be under 30% of your total utilization. 39 to 49 is fair. 50 to 74% is poor, and 74% plus, if you're all maxed out, it's going to very much hurt your credit score. So you want to reduce that credit utilization. But then number two, and this is sometimes a counterintuitive thought process, but if you are in a good position to, an easy way to reduce your credit utilization is, instead of paying something down, actually securing more available credit. So that could be in the form of opening another credit card or securing a line of credit that reports to your personal credit score. That's going to increase your total available credit, which will make the total percentage of that is currently used actually lower without you having to pay off anything. So again, if you're in a good position to do that, that can be a unique way to reduce your credit card utilization or your credit utilization. But again, the easiest way is always to pay it down and make sure that you are under that 30% mark. And one little secret tip here is, if you ask yourself, hey, why is 0 to 9% good, but 74% isn't? And the reason for that is the credit bureaus want to see that you're actually using the credit. So they want you to actually be making some payments, because again, payment history goes into that. So if you're actually using a little bit of it, that can be a very good thing in the eyes of the credit bureau, rather than just using none of it but having it available. But we'll talk a little bit about that a little bit later.
All right. So next step here is to avoid hard credit inquiries. So as you know, whenever someone views what your credit score is, it's considered a credit inquiry. But there are two different kinds of credit inquiries. There's a hard credit inquiry or hard credit check. That's going to lower your credit score slightly. But there's also something that we call a soft check of credit, or a soft credit check, that does not affect your credit score, such as we at Fundera, we only do a soft credit check. So make sure whenever you're providing your social security number for any sort of financial instrument, make sure you ask whether it's going to be considered a hard check or a soft check, to really understand how the difference of these play out. A hard credit check alerts other lenders that you're currently seeking financing. But a soft check of credit just allows a single party to see the credit score without alerting anyone else. For extra protection for your credit score to prevent any sort of hard pulls from taking place or hard credit checks from taking place, you can lock your credit score at each bureau. The easiest way to do that, and it is actually really simple, is if you just do a Google search of lock my credit score, several different options are going to show up right near the top, and it's going to have phone numbers and web addresses to let you lock all of your credit scores at each bureau. There's also several different apps you can download as well, just whichever one you feel more comfortable with. And as a reminder, you will need to unlock your credit score to do both a hard check or a soft check. And then finally, typically lenders will do a hard pull after depositing the funds into the business checking account. So if you were looking for a business loan and you're successful, we got something that fits, and then you're funded, they're going to do a hard pull. But that's not something to worry about, because that's really to protect yourself and also other lenders, to let everyone know that you've been successfully funded and are going to be okay for now. And it's because typically your credit diversity has increased, that offsets the few points that are going to be taken off from the hard check itself.
Awesome. And you may be asking Colin, hey, Colin, but when I go and buy a car, for example, I want to make sure that I get the best price. And if I go to 5 or 6 different dealers and they're all going to do a hard credit check, why does that hurt my credit score when I'm trying to get the best deal here? And I think Colin and myself would both tell you that, again, as he highlighted, the lenders are looking at the hard credit inquiries as an indication of debt-seeking behavior. So they don't know that you're trying to find the best price. They just see that you've gone to multiple different locations and had your credit pulled, which means one company might be lending to you, the dealership down the road might be lending to you. And if you have 4, 5, 6 of those, they might say, well, wait a minute, why would I give this guy a loan if every other place hasn't given him a loan and he's been shopping around? So that's why it's crucial to, really make sure you keep your hard credit inquiries under, really under 6, but if you can, under 2 every 6 months, because they will stay on your credit report longer than some other things. So it's good to have those really, really low and very rarely have your hard credit pulled. Awesome. And now we're going to go into keep your zero balance cards open. So here's an easy tip. If you have a credit card and you've got a limit on it and you've paid it all the way down to 0, don't close out that credit card. And the reason being is that available credit counts towards your total available credit, which can help you with keeping your utilization lower. And I know what you're thinking, Kahmai. If I have that credit card, it's going to burn a hole in my pocket. It's going to sneak out and find its way to Amazon.com and buy up all those new clothes that I don't need. Well, it's just really important to remember that having that credit available is important, but not actually using it is really the key. And again, one tip that I use is I actually have a personal credit card that I use only to buy Babbel, which is a subscription language service. I'm trying to learn Italian as my fiance is Italian. And it happens once every 3 months and I pay it off immediately and I keep that card at 0 because again, it counts towards my payment history, but again, it also counts towards my available credit. And a fun fact is they actually increased my credit limit by 50% without even telling me, simply because I had a good payment history and had kept that card open. So do keep your credit cards open, even if they're at 0 and you're just dying to make a run out to the local mall as soon as they open after COVID.
And just as a quick interjection here, Kahmai, this shouldn't be taken as advice that you should open up a Dillard's card every time you go to the mall. Of course, you should really look hard at whether the deals that the cashier is offering, balance with the benefits here. I wouldn't go around and just opening up every single one, claim it's going to help my utilization. You should always, think very carefully when you do open a new credit line. But like Kahmai said, if you do have any of those Dillard's cards or Old Navy, even though I love Old Navy, might be better to keep them very deep down in your sock drawer and just sort of forget about them for a while.
Exactly. And again, the reason why, to Colin's point, you don't want to open one every month is it's going to count as a hard credit check, right? Every time you open a new card, that's a hard credit check. So you have to balance when to take that out versus when to just say, hey, you know what, I'm going to hold this at zero. Maybe I'll make one payment on it, buy a pack of gum, pay that off immediately, and then I'm back to holding it at zero and have that available credit. So great point, Colin. And finally, disputing derogatory marks in your credit report. This can be a little bit more confusing and a little bit more challenging, especially as we head into COVID times, and there may be more derogatory marks on your reports, as you might have missed payment here or there. But you want to use tools like Credit Karma and others to dispute derogatory marks on your credit. It's relatively easy to do. You can do it either with the bureau itself or through one of these apps. And what disputes do is they just remove old debts that have either already been paid off or weren't actually charged to you from your credit report to help you improve your credit score. So if you had something that goes to collections, unfortunately, but you made that payment, they might not report that to the credit bureau, even though you paid it off. So it'd still be on your credit report as a derogatory mark. You want to make sure that that's removed as soon as possible. You can try and remove anything. If you haven't actually made the payment, they're just going to tell you, hey, you still owe this. It's still active. We're talking to the people who say that you owe them money and you still owe them money. But if you have paid a debt off and you're still seeing it on your credit report, definitely dispute that and have it removed, as it can take some time to get something that is disputed removed from your credit report. So the credit bureaus themselves will go in and do some research and say, oh, hey, he actually has paid this off or she's paid this off. Let's go ahead and remove this from their credit, which is going to improve your credit score.
Okay, so now that the basics are done, we're going to jump into something that's maybe not so basic. And this first thing we're going to add here is that whenever you go over your 30% utilization rate, when opportunity arises. Now, realistically, or ideally, you would want to live in a world where you would never, ever creep above that 30% utilization rate. But in the real world, there are opportunities here that you should take advantage of as a small business owner. For example, if you need to buy $30,000 of inventory because you find a good deal, you should go ahead and do that. And for example, if you only have a $50,000 credit limit, that $30,000 purchase is going to be above that 30% utilization mark, but that's okay. However, you should make sure that you'll be able to pay off that credit card balance to where it's under 30% of your available balance at the end of the month. And also remember that if you jump on any sort of big deals like this, you don't want to carry over too large of a balance, because that extra interest that the credit cards are going to apply will take away any sort of savings that you might get with this opportunity here. But the most important thing to remember with everything that we've said so far, maintaining a good credit score is more of an art. It's not a science. So don't be afraid to sort of experiment, but don't go too crazy, we would recommend.
Keep it simple. Awesome. And now you might be saying, but Colin, if I had $30,000 in my pocket, why would I put it on my credit card? If I have to make this purchase, I've got to make this purchase, and I'm putting it on the credit cards for a reason. I don't have the cash available to pay that down. And that leads us into the not so basics number 2 is, how can I use business debt to increase my credit score? So one of the unique things that we see in and day out is that a lot of folks don't understand the difference between business debt and personal debt. So a credit card, even a business credit card, can report your personal credit, but most business debt options, business term loans, bank term loans, lines of credit, those aren't actually going to report to your personal credit because it's debt that's taken out under your business. So it's going to strictly fall under your business. So for example, if you have a $10,000 credit card debt and you have a maximum credit score, credit limit of 20,000, you're using 50%, obviously. What you could do, as an example, is take out a small business loan of 10,000 to refinance out that credit card debt, which would drop your utilization to 0, help you improve your credit score, and removing that debt from your personal credit and moving it to your business where it should be, especially if you're using that 10,000 to, for Colin's example, buying inventory for your business. That should fall under your business, not on your personal credit score. And a lot of people also don't know that while we're not talking about this today, it can also help you build business credit to have debt under the business. So it's another reason why that's important. One last piece here I'd like to point out. is that a lot of folks don't take this into consideration when they're looking at business debt versus putting something on their credit cards. They might say, hey, you know what, I've got 15% interest on my credit card, 20% interest, 21% interest, and a low monthly payment. Hey, why would I want to take out a debt that might be a higher percentage rate than what I'm paying on my credit card? And the answer to that is because business debt, in the right situation, business debt is almost always going to have a finite term to it. So it's only going to be open for a set period of time. What is that? How's that different than a credit card? Well, a credit card has compounding interest, and there is very rarely a term limit on it. So, if you're making minimum payments on that credit card, it's just going to keep growing and growing and growing because the big credit card companies want as much of your money as possible. Whereas a business lender or business lending institution, it says, hey, I want you to help you grow your business so you can get from A to B. I'm not here to just slowly seep money out of your pockets. So while credit cards can be fantastic in terms of reducing your cash flow and having lower monthly payments, it might actually be time to refinance out some of that credit card debt to improve your credit score, one, but two, and also to help you grow your business in a way that isn't really hurting the business, and you actually end up paying less over time, even though it hurts more right now. I often liken it to ripping off a Band-Aid. Sometimes if you leave the Band-Aid on, it gets goopy and brown and it's gross. But if you just rip it off and you let the air get to it, sometimes it hurts for a moment, but then you're like, wow, I'm actually in a better position now.
Yeah, to piggyback on that example, the credit card companies themselves, and while credit cards are a great tool for anyone, no matter if it's business or personal, they want you to keep a balance on those cards for as long as possible, because they're going to tell you it's only, it's a 15% rate. But what they don't tell you is that it's 15% applied over and over. So what you're actually paying snowballs up. So we're really big advocates over here of trying to get all the debt off your credit cards, because they're multi-billion, if not trillion-dollar companies that have masterminds making it seem as absolutely cheap as possible when you're paying out the wazoo in reality.
Awesome. So that wraps up the information portion of this webinar. Thank you again for attending. We're going to now take some questions here. Colin and I will be happy to answer them if you put them in the chat, and Colin will sort of moderate those, and we'll both answer them as time allows.
Gotcha. So we have some questions here. This is just to let everyone know, this is my first time working with this Zoom question answer thing. So if it goes a little bit, we're going to try to get this done as best we can and to get everyone's questions as possible. So the first question is, why are credit bureaus reducing credit score for persons who don't have a real estate loan? If you could, it says anonymous attendee there. I don't quite understand this question. If you might be able to re-ask that in a few different words, we'd be happy to tackle that. Gotcha. And so the next question we have is, I have one credit card with a $5,000 limit. The Experian rating is 650 after a rough mortgage experience since 2009. And everything's on auto pay now. Should I ask the same company for a higher line or get an additional card? Do prepaid cards help? That's actually a really good question. Thank you. And I'm going to tackle this one, Kahmai. So everything's on auto pay. First off, that's awesome. That's going to make sure that you hit all the minimum payments, and there's going to be no derogatory marks on your card. So should you ask this same company for a higher line or get an additional card? The answer to that is, how happy are you with your credit card company? Because when it comes down to just utilization, the max limit is going to be the max limit, and it doesn't matter whether it's going to be a 10K limit with the same card, or it's a new additional 5,000 with another one. Personally, I like to think that having an additional credit line is going to help, because that's going to increase your diversity of available credit lines. And you never know when you might want to, switch over. If you have a MasterCard, if you have a Capital One card that's backed by MasterCard, you might want to get something else that's backed by Visa. I like to do that. Also, you'll see that different credit cards have different bonus perks, and there's about a million different bonus perks, and I don't think that we'll have time to get into all of them, but that's really just a personal question that you need to ask yourself. I like opening a second card, but there's absolutely no problem with asking for a higher line on your first card. And then your last question here is, do prepaid cards help? And no, they don't help improve your credit. The reason being is that it's not credit at that point because you've already paid it. It's essentially a debit card. A credit functions as something, a promise of sorts between a lender and a borrower, with you being the borrower. But if you've already paid ahead of time, you're not really borrowing anything. They're borrowing money from you and you're taking it back.
Yeah.
Awesome.
Yeah, I was just wanted to piggyback on what Colin was saying as well. Fantastic question. And one thing to consider is, it can't hurt to ask for an extended amount, but then also apply for the card if you're in a good situation to do that. Because again, it's going to increase your total available credit. And if they say, hey, yeah, we can't extend you double, but we'll extend you an extra 500, that plus what you might get in a new card could significantly increase your available credit, right? So sometimes the answer isn't one or A or B. Sometimes it's A and B, right? So the worst thing that they can say is no, and then you're still left with, hey, well, I might apply for a credit elsewhere. But fantastic question.
All right, next question here. When at the mall or a department store and the cashier asks if you want to open a new credit card, is that a hard or soft credit inquiry? I can't speak for every single one. However, I would imagine that it's going to be a hard credit inquiry, always.
Yeah, I would go in with the assumption that it's going to be a hard credit check. But again, this is a situation where it doesn't hurt to ask. More and more, these department stores and lenders in general are trying to move towards using soft credit checks for this exact reason. But again, I would assume that it's going to be hard, and then always ask. Always, always, always ask. Say, hey, is this going to be a hard credit check if I pull this? The 15 or 16-year-old behind the counter might not know the answer to that question, but you might want to read the fine print before you sign on the dotted line.
I wouldn't. Also, I wouldn't bank on having that 15-year-old cashier know the difference at all between a hard and soft credit pull. So just to save you and them some confusion, I wouldn't even bother asking, but I would read the contract like what Kahmai said. Awesome. So next question here. This is actually a really good question. Do EIDL loans show up on your personal credit report? Great question. The EIDL loans are, of course, the Economic Injury Disaster Relief Loans issued by the SBA for these corona times, if you will. And it's a brand new product. I haven't seen them show up on any sort of credit report, so they do not, as far as we understand now. However, it is a brand new thing here. So I want to say for sure that it's not showing up because we haven't seen any sort of impact on anyone's credit score since this program went into effect.
Yes, but and that is true to my understanding as well. As of now, it should just reflect as a business loan. It should not impact your personal credit. I do keep in mind, though, and this is something we've been seeing with folks applying for the SBA 7A working capital loan. The EIDL, if you got it in conjunction with the PPP, the EIDL specifically is really more of a, hey, I'm in a last-ditch situation. A tornado took out my house, or coronavirus forced me to shut down and I have no way of generating revenue. If you're getting that and then trying to secure an SBA 7A loan, which is a growth loan, the banks specifically might look at that in their underwriting process as a negative because, again, EIDL is essentially saying, hey, I had no other options here. Please, someone help me out. And it's lent directly by the SBA, not by bank institutions, as most SBA loans are. So just something to keep in mind there. If you're considering getting an EIDL or if you already have an EIDL, definitely ask whomever you're working with, hey, will this impact my, securing any other business loans specifically?
Man, these are some fantastic questions here. Awesome. So next question up, Kahmai, I'll let you take this one. Which category do student loans fall in as far as credit cards or personal loans or mortgage and car loans?
Yeah, so great question. If I understand the question correctly, Colin, and feel free, if the question's asking, does it fall under business credit or personal credit? I believe student loans are going to fall under your personal credit. Now, if you're asking, hey, will this impact my credit utilization? I believe they fall. Is it more like a credit card, or is it more like a auto loan, or home loan, like we were talking about earlier? My understanding is that it functions more like an auto loan, where it's not going to impact your day-to-day utilization as much, because banks know that you're looking for, a student loan to go to college. You're paying a large amount. You're not going to pay that out over time versus a credit card, for example, which you might be able to pay off in a month or two.
Yeah.
But yeah, fantastic question. But yeah, it falls under your personal, so it will count towards your available credit. But again, if you're paying that down and you have a student loan of 200,000 and you've only got 100,000 left, right? That's going to help you in terms of building your personal credit. And again, it does count towards your diversity as well.
Yeah. If everyone's student loans felt was counted under their personal credit utilization, I don't think anyone
We'd all be in
this,
trouble.
almost anyone in the United States would have under 30% utilization at this point. that's
one other thing to note though with student loans is it's a great way to show two things. One, that's payment history. So you're typically not going to pay that off over a short term. So that's going to help with your actual credit history. But then the other one is make those payments, because if you miss one of those bad boys, it'll show on your personal credit. It's not going to have a huge impact, but it will show on your personal credit. So it's a great way to show history and also have good payment history. So you're saying, hey, I always make that student loan payment. So something to keep in mind there is that it can be a good tool to actually use to your benefit, not just for helping you get an education, but also to help you improve your credit.
All right. And then just a quick follow-up question here. Are there ways to avoid hard credit checks? Like we mentioned earlier, the two best ways to do that is the first is to lock your credit score. That prevents any sort of lender from seeing your credit score. And the second way is to just ask and make sure whether they're doing a hard pull or a soft pull. Or by pull, I mean check. The two words could be used interchangeably. I would go ahead and just ask them directly. And then also the only way you can be sure is if you keep it locked. But if you keep it locked forever, you will have to, you'll never be able to get more credit. So to make sure you ask before you do unlock it.
Yeah. And another thing is you can keep it locked until the time of funding, right? So if you're looking at securing any type of financing, keep your credit score locked. Or if you're trying to get a new credit card, for example, keep it locked until they've approved you, right? Like, hey, if you need to do a soft check, that's fine. I will unlock it for an hour and then lock it again. But I would always say, hey, if this is going to be a hard credit check, make sure you're doing that at the time of funding or at the time you're securing the card, rather than doing it to apply for something, right?
All right. So next question is how to increase the D and B score, or that is I believe it's the Dun and Bradstreet score. Sorry, it's a word that's confusing to say sometimes. I read it much more often than I say it. But the D and B score, and then also an Experian business score. So this seminar we're not going to go really into depth about this, but the best way to improve your business credit score is actually to take out some debt on the business. There's much less complex rules, but it is a completely different set of rules.
Yes, and one thing to note there is you can always ask both bank lenders as well as alternative lenders, hey, do you report to Dun & Bradstreet? Do you report to my business credit? Does this help? Does this loan or does this line of credit help improve my business credit score? And a lot of alternative lenders we've seen in the marketplace have been trying to report positive business credit to those bureaus, such as Dun & Bradstreet, to help basically make their loan products look a little bit better, to add an additional perk to any alternative loan, to help you say, hey, don't always go with a bank. Sometimes it actually can be beneficial to go with an alternative lender who might have a little bit higher rate, but they're going to help you build business credit, and they're a little bit more flexible in the underwriting, and they're a little bit quicker. So something to consider. Just always ask, hey, does this report to my business credit or my Dun & Bradstreet credit?
All right, and then Kahmai, I want to serve this one up for you. How do you get a business line of credit to transfer a personal credit card debt used for the business? Let me rephrase this. How do you transfer your personal credit card debt onto the business?
Yeah, so that's a great question. And to use your line of credit example, because those are very similar, right? You can often use lines of credit very similar to the way that we use credit cards in our day to day personal lives. Um, the easiest way to do that is if you have a balance, apply for a line of credit through either Fundera, obviously, or through your local bank. And if you secure that line of credit, see how much they're approving you for. If that amount is, equal to your current credit card limit, then just secure that line of credit and pay down the current balance on your credit card with your line of credit. A lot of the bank and credit card institutions these days have where you can add the accounts through any of their online app features. So that's more convenient than it probably used to be. And just pay that down, and then now it's going to move to your business credit. Your credit card is down to zero, and you have your business line of credit that you're now paying on. You can also do this with a term loan, surprisingly enough, either through a bank or again through an alternative term loan. And this is kind of where I use the ripping the band-aid off example. The trade-off here is a credit card is going to have a low monthly payment, which means it's not going to impact your cash flow a whole lot month over month, whereas an alternative loan or a traditional term loan through a bank is going to have a little bit higher monthly requirement. But again, it's going to be over a shorter term typically, and it's not going to be compounding interest. And there may, in fact, be benefits to paying it off early. So something to keep in mind there is that, hey, if I want to move this personal debt to my business, I can secure a business loan and just immediately pay that off with the debt, and then slowly pay down that debt through the business loan rather than through the personal side.
These are some fantastic questions. Awesome. All right. So next up is, and I love this one. Does it make sense to get a credit card with a fee? And I'm going to go ahead and take this one here. So the short answer is it depends. So typically, whenever you have a credit card with a fee, and the fees can typically be about $100 a year, those are going to come with some additional perks. And I guess the answer is are those additional perks worth more than the $100 or so a year that it costs to maintain the card? For example, I have historically not been a big fan of getting a credit card with a fee. However, at the end of last year, I got married and then found myself, buying twice as much of everything that I'm used to, and realized that if I were to pay an annualized fee pay an annual fee with a credit card, the points I would get back from going to the grocery store or, what feels like 100 years ago, going to a movie or going out to dinner, even though we don't do that as much anymore in these COVID times, made a lot more sense. And I would actually get much more money back from the credit card company than I was actually paying with, paying the annualized fee for. So I would look into that card and see whether those perks that the card is offering apply to your business, and then how much, and if so, whether they outweigh the cost of the credit card. Awesome. Right. So next question here. Ooh, this is a very specific one. I paid off an automobile for over 5 years. It's never shown up on their credit report. Since it was not showing up on the credit report, they made numerous late payments. Now that it's paid off, if I request for it to be added to my credit report, how will the late payments affect me? Gotcha. I'm going to just take this one here quickly, Kahmai, and I
Sure.
suspect that you'll sort of piggyback off of here. If it was never showing up on your credit card history, I would not be inclined to add that to your credit report because you made late payments. If you look back earlier to think about the stool of your credit score with the 3 legs, a third of your credit score is determined by your payment history, while only about 10% or so is about the diversity of your credit financing options. So it would be a benefit to your credit score in the 10% benefit to your credit score if you were to add that new financing option to your personal report. However, it would be a 30% detriment because it's going to have a negative payment history on there as well. So I wouldn't, if you were able to get away with making late payments and it didn't show up in your credit report, I would count that as a win and move on for my personal answer. Okay, awesome. So Kahmai, it's time for you to get another question here.
All right.
All right, so my credit utilization is very high, unfortunately. Is it better to pay down high interest card rates first or spread out payments to all cards? Ooh, this is good.
Yeah, this is a fantastic question. One of my favorites. And again, the answer here is unfortunately, it depends. If you can, you want to pay down the ones with the most interest, the highest interest rate. But sometimes what we find is that the ones with the highest interest rate aren't always the cards with the highest balance. So again, if you're paying down a high interest credit card to zero, but that card only has a couple $100 on it, and most of your utilization is going to go to a low interest card, that's not going to help you, right? So something to keep in mind there. If you know your highest interest and most used cards are the same card, fantastic, pay that bad boy down. But if it's hey, I've got 1,000 on a high interest card and 2,000 on a little bit lower interest card, which do I pay down first? I would recommend actually paying down the one with the higher balance first. Because it's going to, again, increase utilization a little bit faster, even though you're still paying that slightly higher interest rate. But again, it can depend. And sometimes it's often not as cut and dry as I've got a massive amount versus a low amount. But again, my recommendation would be to get the utilization down as quickly as possible. And one other key might be to look at the card with the highest credit availability. That's another sort of key factor in there as well. So the card with the highest interest rate could be the card that also has the highest credit limit, and also you have the highest debt on because it's got the highest credit limit. In that case, it would make sense to pay that one down. But if it's only got a low limit, paying it down might help you on that specific card, but it's not going to reduce your overall utilization as much. So try and look and see what is the interest rate that I'm paying on each of these cards. Is it negligible? So what I mean by that is, are we talking 24 versus 22, or are we talking 25 versus 15? That difference in interest makes a big difference. But if it's just a couple points higher, 2-3 points higher, it might not make a whole lot of difference of which one you pay down first. You want to get the one that has the highest limit to the lowest amount first, because that's going to have the biggest impact on your total utilization.
Great answer, Kahmai. That's a great answer. Also, something I just want to quickly piggyback there. Please remember, this is an art. It's not a science. There's definitely wrong answers, but there's no specific right answer on this as well. All right. So we have about 10 minutes left. So if you do have another question, please go ahead and add it to the chat to make sure that we get to it. All right. So I have a $50,000 credit limit on my new Visa with a promotional 0% rate for the first 15 months. Should I consider using this card, and will it hurt my score? Great question there. So, of course, you should consider using this card. If you were to max out the $50,000 of your credit limit, that will affect your personal utilization, which will also affect your credit score. Remember, it is important that as soon as you pay off the credit cards, your credit score is going to bounce right back up. But as far as taking advantage of that 0% rate, if your business needs you to use that card and then carry that balance for 15 months, then absolutely, if that's what your business needs to do. I mean, after all, it's a 0% rate. Who can beat that? But remember that once that 15-month mark hits, it's going to hit hard, and and then your entire balance remaining on that card is going to have interest applied to it month after month after month. Now, these are used strategically. These 0% rates are awesome, but they do it for a reason. The goal is to make money off of you, because more often than not, people keep a balance on that over the 15 months, and then they start paying interest on it.
Yeah, and that's all I was going to say as well. So well put, Colin. And just one additional piece to remember is that if you do get close to that 15-month mark, set a reminder in your calendar. Set an alarm on your phone. And then what you can do is, if you have debt on the card, right, you're holding $25,000 on that card, and month 15 is right around the corner, consider refinancing that debt out and putting it on the business. That's a great way to sort of avoid paying those high interest rates. But then also, and I tell this to a lot of our business owners, if you have situations where you need cash flow, you've now just freed up that 25,000 on that card and just shifted that debt to your business. So it's one, not hurting your personal credit score, but two, it's also available to you again to use in short-term situations. We're talking under a month, a couple of weeks if possible.
All right. And so I could answer this question really quickly here. Does co-signing student loans affect personal credit score? And that is a very specific question, but as far as to my knowledge, no. The reason I say that is because if that was the case, we would notice that because Kahmai and I both work with, thousands and thousands of business owners every year, and that would definitely be a noticeable effect across the people that we work with, and it's never been an issue, not even once.
Right. So, good piece to note there, Colin. It will not impact your credit score. One thing to keep in mind, it may impact your global debt service coverage ratio if someone is looking at something like an SBA loan. So they are going to look at the total picture of your debt service coverage ratio, which is a whole nother webinar I promise we'll get to. But just keep that in mind that, that if you do co-sign that student loan and then you try and apply for an SBA 7A or any other bank type loan, they will look at that and see and count that as a debt.
All right. So next question here is, when you are applying for a new credit card, is it beneficial to apply for multiple cards at once? This person that asked the question has heard that if you apply for multiple card at once, then some of those applications are going to squeak through your credit report and not show up. And so the answer to that is that typically, if they're going to do a hard pull, they're going to do a hard pull, even if you apply to multiple at the same time. So I would typically focus at one at a time. These days, they could do things actually pretty quickly here. So, whenever you apply for a new card, it's almost automatic. So I would be careful about that. And then the second question here is, what window of time would qualify as the same time? A week, 2 weeks, or a month? I believe.
Yeah, I can take this, Colin. Hard inquiries, they're going to look back typically on average within the last 6 months. So, if you have a bunch of credit cards that you're applying for and they all do hard credit pulls, those will all hit your credit report. Now, someone noted in the chat I saw while we were going through, and which is a great point, that, sometimes the FICO and the credit bureaus may look at them as similar credit inquiries, and they might not count all of them. But please believe that if you do secure multiple credit cards and they give you credit, they're going to put those as hard inquiries on your credit score. So if you apply for, let's say, 6 and you get 3, there's going to be at the minimum 3 hard inquiries on your credit report, and those are going to last for about 6 months versus, and it could be as high as 6. So just something to keep in mind there. If you need multiple credit cards at once, maybe look at securing a business loan because it sounds like you may need a higher dollar amount in that case as well. It's just my thinking here as I put my funding advisor hat on.
All right, so we got about 5 minutes left here with 5 questions left. So we are going to start the lightning round here.
I love it.
Gotcha. So Kahmai, you are going to have the first one here. My student loans have increased because I'm paying off the credit cards first. My student loans have been deferred due to the pandemic. How much of an impact will this cause on my credit?
I'll pay down those credit cards is the short answer there. Anytime you can get a loan deferred, that's fantastic. Take advantage of COVID. Reach out to any debtors that you have. It will help you improve your credit utilization significantly more, like we said, to pay down those credit cards versus your student loans. Just make sure, like I said earlier, you're making those student loan payments once they do come back on time, because you want to show that positive monthly payment history down the line. So yeah, my point there is if it's been deferred, fantastic. Give yourself a high five and go pay down those credit cards.
Yeah, all things being equal, go after the higher interest debt instruments first. Okay, Kahmai, I'm going to throw this one at you as well. Do EIDL loans show up as disaster loans on your business credit report?
That's a great question. We're not talking business credit today, so but the short answer is I don't know. I would have to check. I don't know if they show up as disaster. I'm assuming they were going to report in some way to your business credit. But again, with everything going on with the EIDL, it's still unclear even to us. So my short answer there is, honestly, I don't know. I would double check with the SBA, frankly,
Yeah.
because they're the only ones who can lend those bad boys out.
Yeah, to quickly piggyback, and we wish we were more prepared for this. The EIDL used to be a very, very rare loan that happened in the space, and it's only in the last, 3 months
Coronavirus, that
that,
everyone got
yeah,
one.
that it's now something to where almost everyone has it. It is going to show up as a loan on your business credit. I would make sure you pay it, but it does have a fantastic rate. So make sure that you still pay that off. Next question here. Does Fundera provide business loans without a personal credit check? We do not. Every single lender in the small business financing space, so on Fundera or off Fundera, is going to look at your personal credit score.
Yeah, and just kind of thinking about it, you wouldn't want them to, right? The only people who provide money to you without checking who you are personally or how your personal credit score is are African princes that are trying to scam you out of your money. So I say this very sincerely. Everyone's going to do a personal credit check. It is part of the financial industry, and I personally wouldn't trust a financial institution that was telling me, "Oh yeah, we can get you money without doing a credit check." That just to me doesn't seem legitimate.
Yeah, this is anything if it was not going to check your personal credit score, that is going to be so expensive your eyeballs will melt. And then secondly, it's also to protect you because they want to make sure that you are who you say you are. If they're not going to check your personal credit, then someone else could be stealing your identity and taking a loan out as well. All right. So next question. Does it make sense to pay off your student loans if you do not have any other loans, such as a home or car? I think I'm going to take this one. I like to think about paying off debt. Is that a student loan's typically 7 or 8%, typically. And then whenever you pay that off early, you're getting a 7 or 8% return on your money. So any sort of extra dollar that you throw towards your debt, specifically here, student loan debt, you're essentially saving 7 cents, which doesn't sound like a lot. But if you could pay up, an extra $100 to your student loan debt, it's an extra $7 you're saving, and then you could multiply that down the way. So yeah, if you have the extra money to put down your student loans, absolutely.
Yeah. Yeah, and I think that the underlying question here, Colin, just to piggyback off it if I can, it sounds like the underlying question is if I pay off my student loan debt because I've had a windfall or whatever the case may be, I will now have no open credit lines. Should that be of a concern to me? And to that, I would say you should pay off your student loan debt early because of the exact reasons that Colin's laid out, but also make sure that you then go and secure some other form of either business or personal credit, just to make sure that you do have at least one active line going.
Gotcha. Okay, so now we are hitting the super lightning round, and I'm just going to read off these and answer these as quickly as possible here. How quickly do actions such as paying down credit cards get reflected in your credit score? It can happen pretty fast, but I would expect up to about 3 weeks for that to sync up with your credit score and have that raised.
Yes, and just note quickly, they do, the credit bureaus are going to run that evaluation about once a week or so. So it might not hit the week you pay it off, but it might hit, like Colin said, a week or two down the line. So just something to keep in note. Your credit score can improve rapidly if you're making those payments.
Okay. What credit score is needed to qualify for a bank loan or a line of credit? Typically 700. There used to be a little bit more leeway before the pandemic, but since then, all lenders have sort of tightened up a little bit and have raised the requirement. So right now you should expect something about a 700 credit score in order to qualify for those longer term loans. All right. Okay, so the final question here is, if I have 8 credit cards with $45,000 of credit available and no late payments since 2012, would it make sense to get a business loan to pay them off in order to increase credit? Great question here, but there's going to have to be, that depends on a few things. First one is I'm not sure how much your total credit utilization is. If you have a super business, you might have $4 million credit limit. So $45,000 is going to be nothing. Second thing is that also depends on what you're trying to to accomplish with that. If you are looking to improve your credit because you're wanting to refinance your house, then yes. Are you paying out the wazoo in interest on all these credit cards? Because typically it's 17% every month added on, and 17% extra added on to that larger amount. It just compounds and compounds and compounds. Typically, we like to, I would say yes, I would try that out. But a lot of that depends on what you're trying to accomplish.
Yeah, and the other piece I would say there also, as we wrap up here, is one, it depends upon how much of a balance you're holding. Get it under 30% utilization if possible. And then two, are you using those credit cards for the business? How frequently are you using them? If you're using them all the time for your business and you're holding a balance month over month, it most likely will make sense to move that debt from your personal to your business. But just something to keep in mind there as you go forward. But yeah, no, it does depend, as Colin said, on your specific situation. We'd be happy to answer that sort of offline here if you wanted to reach out to us to give us more specifics.
All right, and then last question here is great question. My favorite question is who can I ask about credit score questions after the webinar is over? Great question. So where we're going to direct you to is actually our blog portion of Fundera's website. Has a ton of great free information for you that answers a lot of questions specifically about your credit score. A lot of that, it might take some digging. However, most questions that you can have are going to be answered on there.
Yep. And if you do have any questions for us about your credit afterwards, just reach out to us. Or if you reach out to Fundera and they may direct you to us, and we'd be happy to chat with you for 4 or 5 minutes and about your specific situation.
All right. Thank you, everybody, for showing up. We really appreciate it. This was fun.
Awesome. Look forward to doing this again soon. And thank you so much. Have a good one.